In this lesson, what are harmonic price patterns? The learning objectives are: you should know why harmonic price patterns work, you should know the appearance of harmonic price patterns, you should know the types of harmonic price patterns, and you should know the advantages and disadvantages of harmonic price patterns. Harmonic chart patterns are geometric structures based on Fibonacci numbers. Each element of the structure is based on a specific Fibonacci level. So harmonic patterns assume that the price moves in waves and cycles that repeat themselves, and with the knowledge of these cycles, it is possible to try to predict where the price may get to before reversing. Harmonic chart patterns can be challenging to spot and draw, as they consist of a list of conditions required before the pattern can be considered as active and tradable. Harmonic patterns are mostly used on higher timeframes and are more difficult to be identified by day traders and scalpers. Hence, harmonics are mostly used by long-term and swing traders, focused on position trading. They also take a longer period of time to play out given the list of steps that have to be completed. The best timeframes for harmonics trading are daily and weekly charts. The most important reason why harmonic chart patterns work is that being based on Fibonacci ratios, they show traders potential reversal zones before the price gets there. Another reason why they work is that many people are following the patterns, though when they occur, there are many orders in the direction of the price reversal. Hence, it becomes a self-fulfilling prophecy. In general, all harmonic patterns are based from 5 turning points. However, each type of harmonic pattern has a different geometrical shape and Fibonacci ratio. Fibonacci retracements and extensions are key to understanding how harmonic patterns are formed. We name these points X, A, B, C, and D. Each harmonic pattern follows its own set of rules, but the basic ones are: X is the price at which the pattern begins, A is the next price point from X, B is a retracement of X and A, C is a retracement of A and B, and D is the last price point, and also the action though or trigger. Behind you is an example of a harmonic chart pattern, and the one behind you is the ABCD price pattern. The potential reversal zone, or PRZ, is the point in the price chart where a harmonic pattern is completed. The PRZ is the point D. Traders look for trade setups at the PRZ and reversal candlestick patterns, such as bullish and bearish engulfing patterns, make good trade entry triggers at that zone. There are many variations of the harmonic price patterns, but the common ones are as follows. There is the ABCD pattern, free drive pattern, Gartley pattern, bat pattern, crab pattern, butterfly pattern, shark pattern, and the cipher pattern. Every pattern starts with the XA move that initiates a trend. The XA leg in the bearish version of a harmonic pattern is a move lower. The XA leg in the bullish version of a harmonic pattern is a move higher. Each of these patterns has its bullish and bearish versions as they produce a buy and sell signal respectively. Try learning more about each one of them before identifying the best harmonic pattern for your trading style. Drawing harmonic patterns requires a strict following of the guidelines and harmonic ratios. This is because each step is somewhat dependent on the precision of the prior step. Therefore, it is important that you follow the guidelines step by step to verify the legitimacy of the given harmonic. Many trading platforms have inbuilt features for drawing harmonic patterns. Therefore, your job is much easier as you only have to follow the guidelines and connect the dots on a chart. It is important to note that it's almost impossible to identify a perfect pattern. Certain legs will extend higher or come in lower than they should be, but as long as the rough structure of the harmonics is respected, it's fine. There are some advantages and disadvantages of trading harmonic patterns. Because harmonic chart patterns are precisely defined formations, a significant advantage of harmonic chart patterns lies in their structure, which provides us with precisely defined levels to seek. Based on the inputs of each harmonic chart pattern, we can quickly identify the risk associated and profit expected. The Fibonacci ratios help us to identify the entry, stop loss, and take profit. As a result, all harmonic patterns usually generate a very attractive trading setup from the risk perspective. As harmonic chart patterns are objective, traders don't need to interpret the signals produced. The rigidness in structure is what makes harmonic chart patterns extremely rare. Even if a trader identifies points A and B, for instance, point C may not come as expected and everything falls down. Therefore, much patience is needed to identify, draw, and ultimately trade harmonics. Moreover, harmonic formations are one of the most complex patterns as far as the identification phase is concerned. For this reason, they are seen as advanced trading methods used by experienced traders. In conclusion, harmonic price patterns are based on Fibonacci retracements and extensions, and you need to wait for the complete pattern to form before entering a buy or sell position. Harmonic chart patterns show when the price is overextended in a particular direction, so they help in spotting potential trend reversals and pullbacks. To make harmonic patterns more reliable, make sure to pay attention to support and resistance levels. You can also combine harmonic chart patterns with price action reversal patterns such as bullish and bearish engulfing patterns to confirm a potential setup.